So whilst we're going through that polling question, I'd like to welcome on stage with me my three panelists. I have with me today Faryda Lindeman, Senior Responsible Investment Specialist at NN Investment Partners from the Netherlands. We also have Sudhir Roc-Sennett, Head of Thought Leadership and ESG at Vontobel Asset Management from New York. And last but not least, Jaideep Singh Panwar, Corporate Governance and Responsible Investment for Asia Pacific, APG. Please welcome. Thank you all. Welcome. We've, as I mentioned earlier, we've got people from across 11 countries, and I think I might take the fact that I think I've got the most air miles and carbon footprint with us here. And given the room has spoken, I might just get straight into it because we've got a lot to get through, and I think my panelists have a lot to say. So I might just kick off with yourself, Sudhir. ESG is becoming one of the biggest issues for investment markets and for governance in particular. And boards of listed companies need directors who understand ESG and how they should engage around the rest of the market on it. Are boards on top of ESG and megatrends such as climate change, human rights? What is your experience from across the globe, given the diversity of your portfolio, the fact that you're a long-term quality growth investors and you go really deep into your engagement with your boards?
Yeah, that's actually an interesting question because it's immediately going to tangent into something. I mean, the challenge we're long-only equity investors. We're quality growth, 30 years of doing it, and one of the issues we face is actually our fellow shareholders asking the boards to do different things, and so short-term investing is a huge challenge for us because quite often their interests and our interests are not aligned. And so particularly in key moments, M&A or investments into big projects, things like this, the choices that the managements have faced are different requests from different types of investors. So from the long-term investor standpoint, we find obviously boards are very receptive. We'll talk to them. It's very hard to actually influence, the amount of time we engage compared to the amount of time we have actually successful outcome. And I think it's the case if people are honest. Most of the time, particularly in emerging markets, people listen and just get on with their life. And then you can vote against and they get on with their life and there's no consequence. And so it's not until you go public, which is a sort of hostility that we're not so keen on doing, that you can get it. And then it becomes a huge PR nightmare because then you've got every single blogger in the hemisphere trying to talk to you and every single hedge fund trying to get into, and then it becomes a whole different issue of bandwidth of how much effort you put into engagement. So to do engagement effectively, it's a really mixed bag. But in terms of what the boards are doing and the governance, it's changing. It is changing. I think governance is everything, right? It's people run companies, it's the social approach, it's the environmental approach, it's governance, and it's those people. So, I mean, we see them trying, but they get mixed signals.
Faryda, I might pass over to you. Given the nature of your firm, 90% of your portfolio is invested in credit. How does engagement from a credit investor and access to the board differ? What are the challenges when you're a credit investor versus an equity investor trying to engage on topics such as ESG and governance as a whole, generally?
Yeah. Well, I think it's extremely difficult as a credit investor to engage boards on this issue, I have to say, especially when you if companies issue in the private market. I think when companies are also publicly listed, it becomes a bit more easy because there are a lot of transparency requirements around regulations, etc., of what is expected from companies. I remember that, for instance, if we sometimes reach out to a company to ask questions on ESG standards, then they basically answer to us, well, I'm sorry, we have no requirements whatsoever to be transparent about the topic, so we don't really see the need to provide that transparency. So that is changing slowly, I have to say. Over the last year, 2 years, you've seen that changing as well, that also the credit side is sort of opening up for these discussions. But it is something that has been going on quite slowly. I think as well that equity investors always had some type of benefit. So it started, like if you look at the ESG landscape, it started quite long ago with proxy voting on the equity side, right? So this is how sort of responsible investment came into scope, is that people started using their proxy voting rights as an equity investor. And that sort of is a benefit that a lot of the equity holders have, is to use that right to sort of have some influence on boards and to have some influence at the AGM. And I think that's sort of the downside that credit investors don't have. So you have to look for other opportunities to actually discuss it. So that could be actually at the issuance, that you can actually reach out to companies and see if they can disclose that type of information. But also in the investment process, you can try to influence the company.
What role are lead managers playing in that? For example, you know, if they're the ones that are putting these deals together as the lead managers, are you getting engagement from the guys that are doing the book building at the syndication process, for example?
Well, some reach out and ask questions around it. They also ask for advice on what we are looking for, because I think there's a lot of misconceptions on what investors are generally looking for, I think. There, of course, if you look at sort of the ESG standards, there are, you know, data providers and research organizations that ask a lot from companies. And so a lot of companies are sort of struggling to find the real balance between what they need to deliver. So a lot of these lead managers actually reach out to sort of find out from us what we need from these companies in order to report.
Okay. Let's stick on the topic of proxy advisors, and I might take this to Jaideep actually. As more and more foreign investors look to Asia for investing opportunities and domestic investors become more comfortable exerting public pressure, we're witnessing a rise in shareholder activism, and Dr. Sudhir mentioned activism a couple of times there. How does the growth in ESG relate to the rise of proxy advisory firms?
Look, I think, you know, what we've said already is that in the emerging markets, and I look at some certain markets in Asia, one of the things that is stacked against you is that you're typically dealing with controlled companies. And when you've got controlled companies, and you've got voting systems that sort of don't let you, you know, express your vote the way you would like to in a way, or you could vote a certain way and boards can just say, okay, that's so be it. You know, the natural environment that you have, and there are changes taking place in each market as well, is a difficult market to work with. But what we've tried to, you know, do is that, one, if you're wanting to engage, and I'll sort of not use the word activist because we're not activists, we seek to be active investors that seek discussions with the boards, with the managements, is to first, you know, culturally get the rest of the board to start meeting you. So take, for example, I cover some developed markets as well, and Australia is just one example. The boards, if you're among the top 15, 20 investors, typically will come out to look to talk to you, and you can have questions around governance of those companies, and say, okay, these are the things that we're doing. This is what are your opinions on these areas, because there are real teeth built into some of the voting decisions that you can make. In the emerging markets, what we're trying to do is to get companies, to get their board members to come out and meet us, because oftentimes the directors who are non-executives or independent on those boards don't, apart from AGMs, don't really often come out and meet investors, so that level of accountability per se is not there. In some markets, they don't even know how votes were cast. So if you weren't told how votes were cast, the only voice that you really listen to is what management says to you and what you might listen to, you know, from the newspapers. So our approach is try to get access to independent directors on the board, which is hard to do. Try and work with domestic investors, you know, who can be influential. Try and understand the regulatory scenario and, you know, key players in there. But it's important, particularly with large cap names, to look for situations that are catalytic, you know, succession changes, management changes, any, say, you know, publicity issue that they've faced, or certain changes within government where policies are changing. Those are moments that provide you a short, you know, period of time where you can hope to influence the boards and management. So that's what we try and be aware of.
Can I just pick up from, I think, you know, these very accurate points. One of the things I'd just like to add to that is that engagement isn't a by the issue only thing. You have a much greater chance of ongoing effect if you have an ongoing relationship. So if you invest as a partner, you've invested in a company for a decade, and you speak to them a number of times a year, you visit them, they visit you, you have a much better chance that when you need to communicate with the board, they will pick up, they will respond to your email, you get the call. So it's treating these things as partnership relationships. It doesn't mean that you're just listening to all the nonsense. It means it's a partnership, it's two ways. But if you just turn up on the day something occurs to you, then it's going to be much harder to get through.
Yeah. Conduct. There seems to be a lot of focus around conduct and corporate trust. And executive pay is an example of something that continues to be at the forefront of governance discussions. So earlier this year, you actually wrote a piece for your blog titled, "Is the boss worth 20 million?" So, is the boss worth 20 million?
According to him, it's a bargain. So the challenge as investors, is like, how do you think of pay? Is it a percentage of the profits or is it absolute? Of course it's both, but what do you go with? And so, the US is, we sit in the motherland of all big pay stuff, right? So the average American CEO in the S&P gets 1.3% of pre-tax profit. That's how much they get paid on average. That's a $12 million take-home, compared to ACWI, the global, which is about half that. 70 basis points of pre-tax profit is what they get paid. It's about 6 million. And so then the question is like, what type of message does that send to the workforce inside? And of course, the workforce varies by company. If you're a software company making millions of dollars of income per employee, you get one set of eyes. And if you're Disney, where most of your employees are lower income, then you have a very different set of eyes. And Bob Iger, as an example, Disney, it's a $60 million pay package we had to vote on last year for him, and that's, but it's only 50 bips or so of pre-tax. So, how do we have to balance that? Because, 60 million is kind of revolting to most of us. But it's also justifiable if you just look at how it affects the stock. So we're completely split. We're stuck between the great manager and kind of revolting on the society side. And so, our basic comeback is anything over like multi-generational wealth for 1 year's work is just not acceptable. That's just, and the problem is, and you're seeing UK, for example, we had Smith & Nephew CEO just left the UK because he wanted to relist the firm in the States so he could get a higher pay. And this kind of like, sort of market arbitrage, it's not till you kind of get a more level playing field that the CEOs don't get the chance to pick off. And so the States is the place with the greatest issues. But that's an investor thing, and we have real effect. In the States, we have vote, say on pay, but it's not binding. France, for example, if you vote, it is binding. And so there's different impacts depending on the regulations on the different markets as to you as a shareholder, as an investor, how much impact you have. But we certainly engage. They do listen. They might chip a few million off here and there. It doesn't really make a huge difference sometimes. But as they see the votes coming up, things really do change. And Standard Chartered recently had a shock awakening. And but anyway, yeah, that's a quandary. And it's case by case. It's not one size fits all.
So I guess, is there a case for executive pay to be related and linked to certain ESG metrics across the board?
Well, ESG metrics for me is a balance. The one size fits all thing is the really dangerous thing because there's always something which doesn't fit. So, we don't hold that many stocks. We have 160 stocks across all our strategies combined. So we actually spend a lot of time looking at each one individually. We have less than 10 stocks per analyst. And so, but I do feel that when you get above that 20 million mark, you got some serious questions to ask. You really need to be delivering something for everybody to be justifying that kind of absolute. But it is, and eventually, he got passed. He did get his, but his last pay packet's worth potentially more than $200 million if he achieves his goals in 3 years. But
Faryda, it looked like you wanted to say something.
Yeah, well, I think in Europe there has been also a lot of focus on this, and I think it's also that there's more of a stakeholder model in Europe in general, right? France, the Netherlands. If you have a package like in the US, I think the newspapers will be full of it. So it's very difficult to get away with it. But there's always the tendency between, or the balance between financial and non-financial performance criteria. And there has been a lot of focus lately to engage on non-financial performance criteria. and to sort of also make the shift for companies to go to non-financial performance criteria that are materially or financially material to a company, right? So I remember a couple of years ago there were companies that said, well, we're just aligning with the Dow Jones Sustainability Index, and if we perform well, that's, that triggers our ESG track record. But it's more than that. It's to say, okay, for a tech company, retaining talent is extremely important. For extractive company, climate change is extremely important. So how do we tie that performance criteria also to the pay package? And that they're also sort of, not rewarded when they have massive pollution or when people walk away drastically. I think that's also very key. Yeah.
Maybe, one comment from me on pay is in some of the, developed markets, I'm generalizing, is that you've got pay levels that have remained elevated or sort of stuck at fairly elevated levels. And governance professionals have tended to get features on those pay structures, which I see broadly as complexity, but it's not changed the quantum. So what has it done psychologically to the CEO? I don't think too much. But we've been able to show, okay, there are certain features built into it. In many of the markets that I deal with, in the emerging markets, I don't get the information. And pay, so one is, you don't get the information because it's clubbed among the top 15 executives in certain markets. In certain markets, you get the information, and pay is not necessarily the core area from where you get cheated as a minority investor. Because if you're getting cheated on pay as a minority investor in these markets, there are lots of other avenues that a controlling shareholder could have used, that are easier to hide than, blatantly put out pay that is, egregious. So if somebody's got egregious pay as a controlling shareholder in these markets, and that's disclosed, that sort of says something to you about the culture of the management. It tells something to you about, the rest of the people on the board as well. So I think in these markets we look at other ways of where you're getting cheated from. I can talk about one particular case where we pushed the board, this year, to say, look, pay is outrageous. So they announced at the AGM, oh, we're cutting it by 20-30%. We said, wow, that's a big change to see. We didn't expect that to happen. 2 months later, they announced a related party transaction, which was destructive to us as shareholders. And we said, okay, our view around what's changed within the management, let's sort of do a little bit of rethink around it. So.
Interesting. I might shift the conversation a little bit. It's great to see the extent of diversity in this room. I suspect if we were having this same conversation in somewhere like Australia, which is where I manage the business, we'd probably see less than 30% female representation. So I think here in Thailand, the culture is a little bit ahead in certain cases, which is something to be celebrated. Faryda, I'm just going to, since we're the 50% on this side, it's nice to see a balanced room here. In the PwC 2019 Annual Corporate Directors Survey, the survey found that support for boardroom diversity is fading after years in the limelight. And 63% of directors think that shareholders are too focused on board gender diversity. But if we actually dig deeper, is there an ESG skills gap in terms of board composition? And can board diversity help bridge the ESG skills gap?
Well, I think when we sort of start talking about board diversity, it started between, indeed, what you mentioned in the beginning, the gender balance, right? To get the right balance between male and females on the board. And then some countries started adopting a quota. Norway was one of the leading countries to do so. France followed quite quickly. And there are now more countries adopting a quota just to push for that gender diversity. And the problem with that is that, when you sort of have a quota in place, it makes it sort of a box-ticking exercise in terms of, okay, well, we have a female representative. Whether she has the experience is not important. No, she's female, so that will tick the box. So we had to sort of we sort of avoided that discussion but in terms of introducing quotas. But the thing is, the conversation because it started already 10 years ago, and it hasn't really moved the needle so much. If you look at the Netherlands, for instance, we're still not there. We're still not even at the 30% for management and supervisory board level in terms of diversity, which is quite a shocking result to see, that if you start talking about it 10 years ago, it still hasn't happened. Diversity in general is broader than just gender, right? It's also about international experience, culture, and it's to make sure that all people also bring that balance on the board. And also this cultural aspect, or that the international aspect or work aspect is very valuable. And ESG, for instance, if you look at boards with specific people dedicated to the ESG topic, it's quite limited. And the question is why? Well, a lot of times we get companies saying to us, well, we cannot find the right talent to help us out with this discussion, or there are no people out there. It's basically the answer that you get standard. But it's not about that. There are definitely people out there. It's just to make sure that companies also sort of talk to the recruitment agencies and to select the right people that bring also that ESG expertise or that international cultural expertise to the board. And I think it's extremely valuable for also companies to open up around the ESG discussion if you have somebody dedicated on the topic on the board.
Yeah. I mean, quite often, might shift a little bit, quite often you'll find that the ESG teams at the buy-side firms, whether you're an asset manager or an asset owner, typically starts off as a standalone team. And I remember when in Australia we launched the 30% Club Australian chapter in 2015. One of, I won't name the chairman, it was an event for the first year anniversary, I think. And, you know, one of the ESG analysts asked the question, how often are you engaging on ESG topics? And they said, oh, all the time, I speak to your equity team. Now, the equity team is the team that makes the investment decisions, but quite often the ESG team is separate. How do we, I mean, and we're seeing more and more firms bridging that gap so it becomes ingrained in that investment process. So, you know, hopefully there won't be an ESG team in 10 years' time. That's, I think, the mission overall. What steps are your firms taking?
I've got quite a strong view on that. I mean, I think the standalone overlay is a very weak, just isolated thing. It's not like, you can't separate risk from return and just a bunch of people who come in like police and tell you how to do things. It has to be, all the voting decisions has to come from the core analyst who making the buy or the sell recommendation of the stock. If you're not doing that, then the person who's actually ultimately responsible is not taking ownership of the decision. So ESG, I think, has a role as consulting internally. That's how we've always done it. So people who are actually coordinating everything, but ultimately the issues are owned by the PM or by the analysts who actually do the voting or talk to the management directly. They have to own the challenges, otherwise it will not be communicated. And so, I just don't understand this ESG as a separate subject thing. I don't see it as being effective that way. And I fully agree with you, the direction. It needs to be fully owned by the people who actually make the decisions.
So hopefully in 10 years' time, those ESG practitioners will have a new job, a new role.
Well, hopefully the analysts will know something about ESG at that point.
Yeah. Excellent. Jaideep, I might throw, in the interest of time, I've got a quick one for yourself. As Europe's largest investor and with the launch of your new AI Sustainability and Development Goals platform, for those of you who are not aware, hopefully you're all familiar with the term SDGs. How engaged have companies been, and how have they reacted to this? And also, I guess, you know, if we think about ESG and SDG, hopefully there should be some overlap and some consistency. I know it's a very new platform that's been launched to help bring together the concept of SDG goals. What's been the reaction in the market from companies that you engage with, or?
So, you know, this a little bit of context to this. SDGs for us, or Sustainable Development Investment, sits as a subset of what we do within ESG. It comes right from our clients' mandates where they wanted to double their sustainable development investments from about 30 billion euro to 60 billion euro between 2016 to 2020. What we felt was with the announcement of the SDGs that provided an opportunity where the fundamental question is, are we allocating capital towards businesses that provide certain solutions around core sustainable development goals that are material from a sort of global context? So we said, what's probably going to happen now is we're going to have many sets of guidelines and reference points and things of that sort, and that leads to a lot of confusion. So let's create something that's a taxonomy and a platform. And this was announced between APG and PGGM, another Dutch asset manager, which is part of an asset owner, to say, look, let's create an asset owner platform that can be used by asset managers as well, to say, if we want to link our investments to sustainable development investments, this is one potential taxonomy that you could use. I think companies are getting around to understanding what we are talking about, because the question is now turning to what is the impact, right? Previously, you were talking about governance. Previously, you're talking about what sorts of impacts are affecting you as material issues. But what's the impact of your business? And I think there's a lot of education that's going to need to happen. But this is an evolving space.
I guess data is an interesting point. It depends on your investment philosophy and the way that you engage and measure performance. Bloomberg being a data company, we very much believe, as Nitin mentioned, you can't measure. Sorry, I forgot what the quote. Can't change what you can't measure. Thank you very much. So if we think about that, there are fragmented standards across different regions, territories, etc., in the way we capture and think about data. Then there's nuances around sectors and industries and what have you. Is there a case for ESG data to be audited just the way that financial data is audited? And, how do we even begin to think about that?
I mean, the answer is yes. I mean, the problem is, some data, if you've got data, but it's poor data, it's worse than no data. So crappy data gives you just a total misconception of where you are. And you will do things that you wouldn't have done, believing you have better visibility than you actually have. And I think there's been some very clear examples recently. I mean, in the energy space, there's been some very interesting studies about the amount of emissions of methane and CO2 coming from Texas, from the Permian Basin and Eagle Ford, where the reported volumes are less than half than what the third-party verification from satellite measurement, which is now available from the US government. And you're seeing this huge delta. So you might think that you've got one thing, but the data was wrong. You're completely misunderstanding, you're investing the wrong way. So poor data is worse than no data, because you're not questioning it. So I think the verification, it doesn't have to be necessarily government, but it needs to be third-party verified that it is accurate, or at least best possible.
Excellent, thank you. I'm just going to check to see if we've got any questions from the audience. No, we're good. So given that we started off late, I might try and bring us back on track. I'd like to thank all of my panelists. Thank you so much for being the first, and I look forward to catching up with you later on. Please join me in thanking our panelists this morning.